Hello ladies and gentlemen, my name is Christopher Borum and we're here to talk to you today about JetBlue and their IPO. Presenting with me today will be Angel Corrett Rodriguez, Avner Alexis, and Melissa Dienhauer. JetBlue was started in 1999 by David Needleman. It had a strong management team. It had the former vice president of, at the time, Continental Airlines, and John Owen, who was worked for Southwest Airlines, and they had a lot of support. They also had $130 million in funding at the time. Now, David Needleman had a vision for this airline. When he was flying, he came to the conclusion that everything was miserable. There was a lack of entertainment, there was a lack of food, there was a lack of comfortable seating. And he also looked at other discount airlines or low-cost carriers in the process to see what could JetBlue do better. The JetBlue, obviously being a discount carrier, was much different than the legacy airlines such as Delta, Continental, American Airlines. So they had some decisions to make. By 2002, there were 24 A320 aircraft. These aircraft were state-of-the-art, had entertainment systems, and they went to go and try and fix or try and work with the mission statement that David Needleman had. And that's why they have the entertainment and the associated packages with flying on JetBlue. But they did have a problem, right? JetBlue needed capital. JetBlue had a lot of debt. JetBlue was definitely trying to expand into the market, but they needed more money. So they, at the time, they had a negative debt equity ratio, and they were borrowing way too much money. On top of that, there had been a long string of startup airlines that have failed. So JetBlue was very cautious on how they were going to get investors and how are they going to get money. But they saw a large promise in that airline. One of the problems they had setting their stock price was whether to go high or low. And obviously they wanted to get right on the mark. The team felt that pricing too low will leave too much money in retained earnings, and the price too high will send a confident message, but can compromise the deal and compromise future opportunities for raising capital. So this gave them a unique opportunity to set the right price. My group today is going to look at all the aspects of that price setting and come up with our own price using different financial methods. So JetBlue had managed to come out of the post-9/11 era, like many other value-based airlines, unscathed. They were continuing to grow and they wanted to expand their brand awareness. They were looking for higher access to capital, and of course, as I said earlier, with a negative debt-to-equity ratio, they were looking for issuing equity this time instead of additional debt. So there were a couple of advantages to going public. First, you have increased access to capital. Preferable to issue equity instead of raising more debt. And there's obviously the chance to make more equity in the future by selling more shares through a secondary offering, which another member will get into that discussion later on. This is done through a shelf statement. JetBlue also would tend to gain from the IPO through brand awareness. JetBlue, as a low-cost carrier, had a distinct problem. JetBlue flew primarily point-to-point operations in New York, California, and Florida. They didn't have the national awareness that many of the other legacy carriers did that went to the hub-and-spoke model, meaning that there was a big hub, and then either regular-sized planes or small regional jets transported the rest of the people to all of their markets. What this basically means is that JetBlue may have only flown from Fort Lauderdale to New York, but if you flew Delta, you would fly from Fort Lauderdale to Atlanta, and then you can connect to pretty much every city nationwide via another carrier that was a subsidiary of Delta. That means everyone knew who Delta was, everyone knew who United was, but with JetBlue, if you were outside of that target market, you might not have been fully aware of the JetBlue brand, what David Needleman stood for and stands for, and of course with having a very profitable and very recognizable airline that, of course, will do very well for JetBlue in the future. There are some disadvantages to going public, though. Number one, JetBlue stands to lose some of its decision-making ability. Taking on shareholders now means, of course, you have to answer to them, which might not always be in the best interest of the company. They also had to do a lot of compliance with the SEC, right? They wanted to make sure, obviously, that everything was done appropriately. There would also be flotation costs associated with selling the stock. And with flotation costs, they could have come from a variety of sources, such as the gross fee to underwriters, right? Abnormal losses, right? And then green shoe options, which of course could have been carried out by the underwriter if they felt necessary. So, in conclusion of my section, JetBlue was in a prime readiness to get more capital and further expand. Their brand recognition would have gone up. They would have stopped issuing debt, which was way too costly, and make the transition to switching to selling equity instead to raise capital. So I would now like to turn this over to Melissa Dienhauer, who is going to talk to you more about the stock valuation process.
Now, JetBlue's wanted to sell 5.5 million shares for their IPO at a $24 share price. This timeline shows the standard sequence of events in an IPO. You can see that before the first day or before day 0, there's the underwriter selection meeting. In this case, JetBlue selected Morgan Stanley to be their underwriting bank. On day 0, there's an organizational all-hands meeting, and the quiet period begins. The quiet period is a time when the company can continue to do their regular advertising and marketing, but they're being scrutinized that they're not doing anything pumping up their IPO. Days 15 through 44 are due diligence, where the underwriter interviews management, suppliers, and customers. Around day 45, there's the registration date or the announcement of the IPO. Days 45 through 75, the SEC will be reviewing all of the filings. Within that period, on day 50, the company will distribute the preliminary prospectus, which is also known as a red herring. And days 60 through 75 is the road show or the road tour, where the company goes and meets with interested institutional investors trying to build interest in the IPO. Days 75 through 99, letters of comment from the SEC are received. Day 99 is the effective date, which is where the underwriter and the firm give their price offering. The SEC gives final approval. Day 100 is the public offer date. The stock is issued and begins trading. And day 108 is the settlement date, after which the underwriter will distribute the proceeds to the issuing firm. Beyond that, the underwriter will continue to support the new equity by distributing literature and marketing materials. There are two ways to value stock. One is by analyzing cash flows. And in analyzing cash flows, you can look at dividends. In this case, JetBlue had neither paid dividends in the past, nor did they plan to. So we didn't look at that. But you can also look at the estimated free cash flows. And free cash flows are the parts belonging to the creditors and shareholders. Another method that we did use is comparing financial information from competitors in the industry. Here we looked at the average or the mean revenue growth for other low-cost carriers, but you can see that the growth rates are all over the place and the standard deviation is relatively quite high, which would indicate that these companies are not that similar to JetBlue. Southwest is kind of the closest one. So you should take those numbers with a grain of salt because it would indicate that the companies aren't that similar. But using what we have, we use the price-earnings ratio and applied it to this formula, which is the competitor's price per earnings times JetBlue's earnings per share. Earnings cancel out and you get JetBlue's price per share. We use the numbers that we had for 2001 as well as the estimated numbers for 2002. And even though there's a big difference between them, when you take the average, 25.15, it's actually very close to the targeted share price of $24.
Alright, so now I'm going to talk about the other second way that we can value the stock of JetBlue. So we saw that the first method involves comparing it to competitors that might or might not be very similar to JetBlue, so that brings some problems. Using the free cash flow model, we avoid comparing it to other companies. We just use internal information. So it's a way to avoid that problem. Now here in this case, we still have to make some assumptions because we don't have all the information we need, so we have to borrow some information from Southwest. But at least from the other tables, we saw that Southwest looks a lot more like JetBlue, at least revenue growth, than the other companies. So the way that the free cash flow model works is we find all the free cash flow, which is the cash flow that belongs to just the creditors and the stockholders. We discount that cash flow. In this case, we use a WACC to discount the cash flow and account for the time value of money. And then we just subtract the value of the debt and the preferred stock just to leave the value of what the stockholders hold. Just to grab that value, we divide it by the number of shares, and we have the price per share. So that's a way we can do to solve for that problem. Now, as we said, we have to make some assumptions, and from the balance sheet, we were able to calculate each way or in each value of the company. As you can see, we still have a little problem. Equity is negative. So one thing we can do is we can use other companies to look for the capital structure of competitors and see if their capital structure looks like JetBlue. In this case, we don't have that information, so we had to leave the equity is negative. That's probably not the best thing to do, but we worked with the numbers we had, and even though it shouldn't matter that much since equity is such a small percentage compared to debt and the preferred stock, so the calculations, even when we tried using positive numbers, it didn't change much the calculation of the WACC. The first thing we used was to calculate the cost of equity, and from the case we got the market return and the risk-free rate, and we had to borrow the beta from Southwest. That one, we cannot calculate the beta with information we have from JetBlue, so we used Southwest, and that suffers from the same problems that the multiples valuation method. Southwest is similar to JetBlue, but it's not the same. After using the CAPM to find the cost of equity, we got that the cost of equity was 11.65. Now, there's two ways we could have calculated the debt. The first way, since JetBlue doesn't have any public debt, we could look at the public debt of Southwest, see how much that's the cost of the debt, and then add a certain premium. We decided to add a premium of 3% because Southwest is a lot more stable. It's got bonds rating that it's really close to AA, so we know that JetBlue is not that well rated, so we decided to add a premium. If we use that method, we get that the cost of debt is 9.91%. The other way we decided to find the cost of debt was to grab all the debt outstanding, the long-term debt and the short-term borrowings. Preferred, we didn't look at the preferred, and we divided it by the interest extent, or the interest expenses minus the total debt, or divided by the total debt. That gave us a much higher value of cost of debt, which was 16.87. Now that number seems like way too big, especially because that number is larger than the cost of equity. But if we look at the balance sheet, JetBlue has more liabilities than assets. That means that owners owe money. It has a lot of debt, so that's probably one of the reasons why debt is so large. What we decided to do is we grabbed those both numbers, 9.91 and 16.87, and we made an average, and that's what we used to calculate the cost of debt. So we found that the cost of debt and the after cost of debt were these two figures. Now, to find the preferred cost of stock, we really had to go blind because we didn't have the number of shares of preferred stock outstanding. So we just had to make an estimate. We decided to go with 10% because that is less than the cost of debt, but more than the after-tax cost of debt. So it was just a ballpark figure that we had to use. In the end, we decided that the weighted average cost of capital was 12.2%. Now that we have calculated the weighted average cost of capital, we could go ahead and find a final value of the shares. We calculated the free cash flow by getting the NOPAT, which is basically the net operating expenses, the EBIT times the tax yield. You subtract capital expenditures minus net working capital, and you find a value. We subtracted, we discounted it by using the WACC, and we decided, since we only had revenue or free cash flow was calculated all the way to 2010 using information from the case, we decided to add a growth rate. We assumed that the free cash flow was going to grow at a rate of 10% every year after that. So we included a growth rate, and we ended with a value of 19% or $19 per share. So that's lower than the 25 that we found using the multiples, but it's still within the range that the case talks. And especially if you consider that Southwest's stock is $20 and some cents, this seems like a figure that's not way out of line.
Good evening. My name is Abner Alexis, and I will be going over the recommendation for Group 7. Group 7, our recommendation to JetBlue is that they should stay in the conservative range of $22 to $24. Now, there's mixed views on the IPO, the pricing of this stock. And on one end, analysts believe there's a large momentum behind JetBlue because of their brand awareness and how they were virtually unaffected after 9/11, that there are a lot of interested investors that would pay a higher price IPO. Now, there are some issues with pricing a higher stock. But these analysts believe, because of these reasons and because of the momentum, just pricing it a little higher, JetBlue can make over $200 million at a higher stock price. Now, in our opinion, in Group 7's opinion, JetBlue, through our research and analyzing data, they can't afford to raise more debt. They owe too much money already. And it would be better for them to actually raise more equity than debt, because their debt to equity ratio is negative. They own more liability than equity. The owners of the company actually even more owe money. And at this time, they have a lower rating, and they're actually seen a little bit more riskier to loan money to, and it will cost them more money at a higher interest rate to borrow in order to fund future capital expenditures. So we suggest pricing the stock around $22 for this reason. Now, another reason that they should really price the stock at $22 is when you look at JetBlue's 10-year growth chart. In 10 years, JetBlue's growth, despite the momentum behind the stock, it actually begins to slow down in 10 years. But you know what is not slowing down? Southwest's stock. Southwest, another low fare price strategy airline, they actually grow at twice the size of JetBlue at the moment. And they're not planning on slowing down. And JetBlue, having to keep up with Southwest and wanting to purchase more airlines and planes that obviously cost a lot more, they will actually put themselves in the hole. And that is why they absolutely cannot afford to take on more debt. Not right now, not even in 10 years. And in 10 years it'll be a lot worse, because while Southwest is growing at twice the amount that JetBlue is, in 10 years, if JetBlue offers a secondary offering, their growth, it just won't be worth it. Why buy a stock that's underperforming and you have another competitor that's performing a lot higher? It just will not work for them in the future. So what we suggest is, if they price it low right now, it has benefits that will last them even in 10 years when their growth is actually slowing down. And the reason for this is the underpricing strategy. Now, pricing it lower now, investors can make a lot more money on the stock. And in 10 years, when the growth starts slowing down, investors will be a lot more satisfied, a lot more happy with a lower priced stock, and will be more interested in purchasing a stock that's lower than Southwest. And for this reason, this underpricing now or leaving money on the table now actually helps Southwest, actually helps JetBlue in the long run. Especially when in 10 years, when it's time to offer a second offering, it will work in their favor.
On behalf of our group, thank you for allowing us to discuss JetBlue's IPO with you today. We've listed on the last slide of your presentation where you can find additional information, or please feel free to email us directly with any additional questions.